If you use Fibonacci extension, which is a great way to gauge momentum, it gives you an idea of where upside potential targets are, how much momentum gold could have. It comes out to 2,750 for gold, 27 to 2,750. And that is a 20-year price chart pattern. And we've been watching this, and we saw gold break out. It started a new super cycle in 2019. And ever since then, we've had that 2,750 target for years. And it's finally at that point. And the fact that gold is rocketing higher, it's doing the same as what it did in 2007. It went dormant for several years. 2005, 2006, gold stocks skyrocketed everywhere. Well, we've just seen the same thing. We've seen gold go sideways for several years. We've got a bubble in every asset class, but now gold's starting to outperform just like it did in 2007.
Gold prices turned positive for the third consecutive day on Monday, climbing to the $2,667 mark, its highest level in over a week, during the early European session. The rise in gold prices is primarily driven by growing expectations that the Federal Reserve will continue cutting interest rates amid a favorable inflation outlook. Additionally, escalating geopolitical tensions in the Middle East further support the safe haven asset. ChrisVermeulen, a seasoned market expert and founder of the Technical Traders, has long predicted gold's upward trajectory using technical analysis. Vermeulen notes that applying Fibonacci extensions, a tool used to gauge the strength and momentum of price movements, has pointed to a long-term target of $2,750 for gold. This level has been anticipated for years, and gold is approaching that milestone. Gold prices may find initial support near the $2,632 to $2,630 range, with further potential support at $2,600 and $2,560. Continued downward pressure could extend the decline to $2,535 to $2,530 and $2,500. This week's primary drivers of gold price movements have been shifting expectations around U.S. inflation and Federal Reserve policy. Early in the week, better-than-expected non-farm payroll data cast doubt on the extent of potential rate cuts, leading to a sell-off that pushed gold to its lowest point in 2 weeks. However, U.S. inflation data released on Thursday showed a slight rise but marked the slowest annual increase in over 3 years, reigniting hopes of a Fed rate cut at its November meeting, helping gold recover. Vermeulen also points out that in a recession or bear market, gold and silver prices could face significant pullbacks. However, he notes that if a significant global event such as war or another crisis unfolds, gold prices could spike higher due to its safe haven appeal. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The S&P 500 is doing pretty nice. I mean, the big tech are kind of holding the NASDAQ down. They're kind of holding it ransom from moving upward. The S&P 500 is threatening all-time highs again. But for sure, gold, we've been talking about gold for years. If you go back to, 2002, 2003, from the bottom where gold started a new super cycle to the peak in 2011, and then down to the bottom back in 2015, 16 area. If you use Fibonacci extension, which is a great way to gauge momentum, it gives you an idea of where upside potential targets are, how much momentum gold could have. It comes out to 2,750 for gold, 27 to 2,750. And that is a 20-year price chart pattern. And we've been watching this, and we saw gold break out. It started a new super cycle in 2019. And ever since then, we've had that 2,750 target for years. And it's finally at that point. And the fact that gold is rocketing higher, it's doing the same as what it did in 2007. It went dormant for several years. 2005, 2006, gold stocks skyrocketed everywhere. Well, we've just seen the same thing. We've seen gold go sideways for several years. We've got a bubble in every asset class, but now gold's starting to outperform just like it did in 2007. And to me, gold think of the world, the globe, the planet Earth is like a hive, a beehive. And it's like every investor is like a hive mentality. When gold starts to outperform and takes the lead, it means the whole hive, everybody's getting nervous. It's a big warning sign that a financial reset, something is going to happen that we don't know what it'll be yet. And we'll call the recession or the correction after that, give it a name after that. But gold it's doing exactly what it should do. I think most of the upside in gold is done right now. I think there's very little upside left. I feel like we're going to go into a recession. If we go into a bear market, we're probably going to see gold and silver get pulled back very hard, potentially 20, 30% or so. Unless there is a black swan event, say nukes or bombs start going off and another World War III really kicks in. that is obviously going to be a black swan that spikes crude oil, spikes gold pricing. So there is that side, but gold is moved where we expect. It's done its move, in my opinion. I don't think there's a whole lot to jump into. I think we wait for a reset before you add more to your position.
ChrisVermeulen has expressed a positive outlook on equities, highlighting potential upside, particularly in the Nasdaq and S&P 500. Despite recent corrections and spikes in volatility, there is growing confidence that the markets could rally further. This sentiment aligns with recent developments in U.S. stocks as markets continue to hit fresh record highs. On Monday, U.S. stocks rose once again, driven by gains in Nvidia. The S&P 500 climbed 0.7%, nearing another record after closing above 5,800 for the first time on Friday. The tech-heavy Nasdaq Composite also advanced 0.7%, while the Dow Jones Industrial Average gained over 100 points, or 0.4%. These gains follow a strong showing last week when the Dow and S&P 500 closed at new records, thanks partly to upbeat earnings reports from J.P. Morgan Chase and Wells Fargo. As earnings season continues, investors are now focusing on more big banks, with reports from Goldman Sachs, Citigroup, and Bank of America set to be released on Tuesday, followed by Morgan Stanley on Wednesday. Let's get back to the interview.
I've been very bearish on the markets for a long time, but there's a huge difference between what we think and feel is going to happen versus what you need to do. So for example, I've been thinking the markets have been topping for a couple of years. I think that's what I've been talking about. Things have been slowly lining up every month or every quarter. Things line up even more and more. And the pink is really getting thick here now that gold has hit a measured move of a major cycle top and all this stuff. And utilities are now screaming higher. There's a whole bunch of things coming together. But the key, I think, for people to understand is don't invest or trade on what people think or feel. And while I'm super bearish on the markets, we are long the market because the trend is still up. And this is the big disconnect is, yes, I'm bearish, but the trend is up. We follow the coattails of the market. So we identify if the trend is going up, then we're going to ride the market up. I mean, I have the same thing. I talk to subscribers all the time. They're like, why are we going long the markets when you're saying we're going to have Armageddon, like the end is coming. And I'm like, that's what I'm trying to mentally prepare you for, because one of these times when we have a sell signal and we exit and there's a correction, it's going to take potentially years to unfold and you don't want to be holding. But until then, we have to ride this market up. And that's really the key is follow price. Don't try and lead it. And people always say, well, technical analysis is voodoo. And they're like, you're picking tops, you're a market timer. And I say it's the complete opposite the way I do. I'm not a market timer. I don't pick tops or bottoms. I follow the markets. So I get in after it's clearly bottomed. I never get in near the bottom. And I get out after the top has been clearly put in and the trend is down. So I don't have to do a lot of work other than identify as has this trend come to an end? And do I need out? Is there enough momentum that we need to exit? It looks like bonds are starting to come to life. I mean, we're still long the equities market here, but bonds are starting to come to life. And the big question is, I think, how is the economic data? What's the Fed going to do over the next, quarter or so? That's going to give some good insight, I think. I think the economy is slowly grinding down and slowing. That I think we'll hit a tipping point where we'll be confident rates are going to continue to fall. But right now we're still in no man's land. But bonds, their chart pattern and everything looks very much so like a major bottom is getting put in place. Equities, I mean, we're looking at the NASDAQ. The NASDAQ has about 8% upside potential from where we are right now. So there's still actually quite a bit of upside. The SP 500, I think, can rally about 4 or 5% from where it is right now. So, I mean, right now, I like the equities market. Right now, when we were looking at money flows, where's money flowing and what's going on in the markets, equities is the place to still be in. I think it has the best potential and there's still some upside left in that. And because we kind of just focus on one asset class at a time, the other ones we don't really care about because we want to take the most volatile one, which is the equities market, if it is favorable. We don't want to go to something really slow when there's a clean signal in equities to go long. So I think equities is still the play. I think there is that huge wall of worry. We just saw that massive correction in August. We saw the VIX spike like 175% in one day, massive gap down. We saw panic selling on the New York Stock Exchange. I have this little indicator that shows us if people are panic selling or if they have FOMO, tells us usually short-term pivot highs and pivot lows on the markets. And it maxed out as well. So we we've had a cleansing event over the past 2 months, really. And now the market is primed and ready for another big leg higher. And people are nervous. It seems like everybody right now keeps telling me like they're worried to be long stocks. They think the market's falling. They're not acting normal. But really, when I look at the stock charts and everything else, I'm like, it's just normal price action. And the underlying trend is up. Money is flowing in. There's definitely some distribution selling going on. We were looking at on the intraday charts today. There's some huge institutions unloading huge amounts of their portfolio. They keep hitting the market. Every time it gets up to a resistance area, we see high volume. So it's distribution selling, but that's normal. That's just big profit taking from institutions that take months and months and months to unload their portfolios. So it's another warning sign, but doesn't mean the top is in yet.
Gold's steady rise this week highlights its growing appeal as a safe haven asset amidst escalating geopolitical tensions and the Federal Reserve's expectations of further interest rate cuts. With technical analysis pointing to higher long-term targets, gold shows resilience despite market fluctuations. Additionally, stock markets like the S&P 500 and Nasdaq remain upward, benefiting from robust earnings reports and optimism for a soft landing in the economy. Will the potential for further rate cuts sustain the upward momentum in gold prices, or will upcoming economic data shift market expectations? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.